In our last lesson, you learned how to interpret and identify manipulation of retail orders at potential areas of deep liquidity. In this section, you're going to learn a very powerful technique that will allow you to confirm that a stop run has taken place and also increase the probability of a successful trade. And we do this through the use of currency correlation and stop hunts. So identifying correlation within the price action of two or more relevant currency pairs can help to reinforce and increase the probability of a successful trade. And earlier on in this course, you learnt that many currency pairs will move in line with each other the majority of the time. And examples of this were the euro dollar and the sterling dollar, the euro yen and the sterling yen, and also the dollar yen and the dollar Swiss. So when stop runs or M&W formations at identified manipulation zones take place at the same time in correlated pairs, the probability of a successful trade is greatly increased. Okay, so we're simply looking for the stop run that we have identified, or the M&W formation that we have identified at a manipulation zone to take place in a highly correlated currency pair. So if we're looking at the euro dollar, and we've identified through our candlestick formations a stop run taking place at an identified level, and then we flick over to the sterling against the dollar and we see a stop run or an M&W formation taking place at the same time at an identified level, the probability of a successful trade will be greatly increased. Okay, because we're seeing the stop run of two correlated pairs taking place within a relatively narrow time frame. So checking for correlation between two pairs and the respective cross pair can help you to identify which currency pair has the most potential at a greater return. So what do I mean by this? Well, if you're looking at the euro dollar and the sterling against the dollar, and you have identified that a stop run is taking place within a relatively narrow time frame at identified levels, you will have the problem of choosing which currency pair to trade over the other. Now, if you're more comfortable trading the euro dollar over the sterling dollar, then by all means take the trade in the euro dollar and vice versa, but it doesn't necessarily mean that you're going to get the greatest return. And the way that you can look at what currency pair is potentially going to give you the greatest move and the greatest return, you'll do this by looking at the respective cross pair, and in the example I've given, this would be the euro against the sterling. Okay, in this first example, we're looking at the euro dollar and also the pound against the dollar, and the date is the 28th of August and it's 2014. On both of the charts, I've marked off the Asian highs, which is represented by the red line. Now, in the euro dollar, we get a first test of the highs, which takes place at 8 o'clock. And we can see smart money have induced buyers into the market, which smart money sell into with this aggressive move to the downside. And then we get our second bar, which fails to confirm because it does not close within its lower 1/3 region. We then get a bounce to the upside and a second test of the Asian highs, and we get another stop run candle, which is then confirmed down, and then we get the trend to the downside. Now, for those of you with a sharp eye, you will notice that we have our classic M formation take place, and we have the shorter second leg before the market begins the daily trend. So we have the first stop run take place at 8 o'clock, which is the first leg of the M formation, and then we get a second test of the Asian highs, which forms the shorter M formation at 9:15. Now if we switch over to the sterling against the dollar, we notice that at 9:15 we also get a stop run of the Asian highs. Okay, so we have a correlation of stop hunts on correlated pairs. In the euro dollar, we had the second leg of the M formation, which penetrated the Asian highs, and at the same time on the sterling against the dollar, we had an aggressive move to the upside, where smart money induced the buyers into the market. We then see an immediate rejection following our stop run candle. We get a higher low, so this becomes our new stop run candle, and then we get our confirmation, and then our pullback candle take place. So at 9:15 on both the euro dollar and also the sterling against the dollar, we had a stop run of the Asian highs on the intraday session, and then we had confirmation and then the unfolding of the daily trend. Okay, so very simple and straightforward. You're simply looking for two correlated pairs that have stop runs at identified areas of potential deep liquidity taking place within a relatively narrow time frame. Now the time doesn't have to be exact. In this example, you saw we had a stop run at 8 o'clock on the euro dollar, but we didn't have one on cable or the sterling against the dollar. But then we had the second leg of the M formation come back up and test the highs, and this correlated with the stop run on the sterling against the dollar. Now, once we've seen the correlation between the stop hunts on both of the pairs, for traders that don't have a preference between the currency pairs that they trade but are simply looking for the greatest returns, how do we identify which one of the pairs will give us the greatest move? Okay, so if we measure the high to low range of the trends on the euro dollar, we have 58.9 points, so we'll say 59 points. But on sterling against the dollar, I've used the wrong tool there, we have 46 points. So clearly the euro dollar would have given you the greatest return, but how do we work out beforehand which is likely to do so? Well, we simply go to the cross pair of the two respective charts. So we would look at the euro against the sterling. Okay, so if we go over to the euro against the sterling, and again we're on the 28th of August 2014. Now at 8 o'clock, which correlates with the first stop run on the euro dollar, we can see a stop run of the Asian highs. Okay, so we can see that smart money are inducing buyers into the market, and they're going to sell into this and unfold the trend to the downside. So this currency pair being the euro sterling, if we identify that they're inducing buyers into the market so they can sell into this buying pressure, then the smart money analysis of the euro against the sterling is euro weakness. Okay, because if they're selling into the buying pressure and we know they're going to push the market to the downside, their analysis is that the euro against the sterling, that the euro is weak and the sterling is strong. So if we look at that, and we know that on both the sterling against the dollar and the euro against the dollar that we're currently within a downtrend, we're going to be looking to trade the euro. Okay, because the euro against the euro is weak and the sterling is strong. And if we're in a downtrend on both of the respective pairs, then we're going to want to trade with the weaker currency pair. Okay, so we see stop run of the highs. We then get a lower high, so a higher low take place. Then we then get confirmation, and we get our pullback candle. So if we have euro weakness in terms of the pairs that we want to trade out of the two correlated stop runs, we'll be looking to trade the euro dollar. In this next example, we're looking at another set of highly correlated pairs, and this is the sterling yen versus the euro yen. So we're looking for the exact same process as we did in the last example. We're simply going to be looking for the manipulation of retail orders at an identified level within a relatively narrow time frame. In this example, I've marked off the Asian lows as our potential manipulation area, and in the sterling yen we see at 7:30 we get an aggressive candle to the downside which penetrates our zone by 3 points. This becomes our stop run candle, and then immediately afterwards we get a candle which closes above the body of our stop run candle and give us our confirmation of manipulation. Now in the euro yen we have no manipulation of the Asian lows. Okay, so if we have no manipulation of the Asian lows, does this necessarily mean that we don't take a trade? Well, of course not. We always keep in line with the smart money cycle. This is simply a process that you can use to reinforce and confirm a trade entry decision. Okay, so in this example we have no stop run at the euro yen at 7:30, but we have a clear stop hunt and confirmation in the sterling yen. So there is another currency pair that we can use when we're trading the sterling yen and the euro yen, and we can use this other currency pair also for correlation and confirmation, and this currency pair is the dollar yen. So if I bring up the dollar yen, immediately we can see that we have an identical stop run to our sterling. At 7:30 we have a stop run of the lows with an aggressive candle which penetrates our level by more than 3 points. We then have a failure to confirm, but we have a lower high. We then get our confirmation candle which closes within its higher 1/3 region, and then we receive our pullback candle. So within two currency pairs which are highly correlated, the sterling yen and also the dollar yen, we have stop runs of the Asian lows. Now what's interesting is as we enter into the US session, and if I mark off the zones, at 1:30 as the US session opens, we have a stop run of a previous level of support of resistance, and we get the same process take place within the dollar yen. Okay, so this could also be used to assist you when trading the New York reversal. Okay, so at 1:30, as we enter into the US session, we have a stop run on both of the highly correlated pairs, and we get confirmation down on the next bar, and this would give you more than enough reinforcement and confirmation that a stop run had taken place and allow you to comfortably pull the trigger and enter into the New York reversal. And this is also true with the previous two pairs we looked at during the midweek reversal. If you see a correlation of stop hunts to the up or the downside take place within a relatively narrow time frame, you can pull the trigger with that added confirmation that the highly correlated pairs are also doing the same thing. In this final example, we're going to take a look at two currency pairs which have a high degree of negative correlation, and in cases where you're dealing with two currency pairs that do have a negative correlation, you simply want to look for the same process but on the other end of the trend. So if, for example, we're looking at the dollar Swiss against the euro dollar, and they are highly negative in their correlation. So if we're in a bear trend on the dollar Swiss and we see manipulation, and we also see the same manipulation taking place in a bull trend on the euro dollar, then the stop hunts will be correlated. So in this example, we're looking at the 1st of September 2014, and we can see that the dollar Swiss is in a clear move to the downside. We have a previous level of support and resistance that I've marked out, and we can see through the candlesticks that we have that aggressive move through our identified zone. Our next candle gives us a lower high, which creates our new stop run candle. We then get no confirmation on our second, our third, but on our fourth bar we get an aggressive move to the upside, and we have the body of the candle close within its higher 1/3 region. Now once we get these aggressive candles, we're always going to look for a pullback, which we receive, which could then allow us to enter into a trade. Now the stop hunt of our prior level of support and resistance occurred at 9:45, so a couple hours into the London session. And if we go over to the euro dollar, which is negatively correlated to the dollar Swiss, we get the same process take place at the same time. So we have a previous level of manipulation, which is a potential area of deep liquidity, and at 9:45 we get an aggressive candle through our identified area. Our next candle gives us a lower high. We then get another lower high, so we have a new stop run candle. We fail to confirm on the next candle down, even though it closes below the body of a new stop run candle. It's not within its lower 1/3 region. And then finally we get an aggressive move down and our confirmation. So with negatively correlated pairs, we're simply looking for the correlation of stop hunts, but at the other end of the trend. So if we see a bull trend in one and manipulation, we're going to be looking for a bear trend and manipulation in the other. Okay, so the identification of stop hunts within a relatively narrow time frame in highly correlated pairs can help you to reinforce and confirm a trade before you pull the trigger. Now, when we looked at our section on identifying the phases and trading in line with the smart money trend, we identified that phase 3 and phase 1 are the most difficult to trade. So when we're in phase 3, which was level 3 accumulation, you learnt that we would generally trade both sides of the market, and this is because there was no identifiable trend to the up or to the downside, and the market generally stayed within a relatively tight range until the breakout and the formation of phase 1. Now, because this is the most difficult phase of the smart money cycle, correlation and the identification of stop hunts is a great tool to assist you when the market is within these ranges. Because if we're trading both sides of a market, we have a disadvantage because there is no cycle. So if we identify at a high probability area that the stop hunt is taking place within two correlated pairs, and we're in phase 3 or level 3 accumulation, this can add further confirmation and also reinforcement that the probability of your trade will be a success. So currency correlation can help with the everyday intraday trading, as long as we're obviously in line with the smart money trend. But for those more difficult phases, such as level 3 accumulation and the identification of phase 1, it's a great tool to assist you in your analysis and your trade entry decisions.